You're listening to Real Investor Radio with Craig Fuhr and Jack Bavier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, welcome back to Real Investor Radio. I'm Craig Fuhr, and we're joined again by Jack Bavier and Sean Tierney. Listen, if you didn't have a chance to listen to the previous episode, covered a lot of ground there with Sean and Jack. I talked about projections for the 5-year Treasury, which is important for anyone who's doing DSCR loans over the next 12 months. We talked a lot about sort of the state of DSCR and single family as an institutional asset. So just a great conversation with you, Sean. Can't thank you enough for spending another episode with us. I want to, see if we can focus on, we talked about your amazing trajectory from college to Morgan Stanley to then going out and working for a firm to raise $453 million. And can't forget the three. And the question I have is, so how do you go from that, which was, Havenbrook Homes, correct? Mm-hmm. How do you go from that then to Entera? You mentioned that Entera was founded in 2018. When did you join the company?
I joined in 2019. So I'm coming up here on my 6-year anniversary. I joined right after it was our Series A, our seed round funding. Sorry.
Did you know the principals in the company?
I did, yes. So, and Jack may know him too. My CEO, current CEO, Martin Kay, he had been involved in the SFR space as an owner and an owner-operator and as a buyer for a lot of groups, a lot of the institutions, what I would refer to as SFR 1.0 in Texas. And so using his companies, and he had always been in technology and big data, and he really saw the opportunity to combine these two spaces of big data and SFR and to provide a platform and a system for the large institutions because they had still been so, algorithmic in their acquisitions. And so that was sort of where he came up for the idea. And I had known him, at my acquisition days from Sullivan Road. We would, I'm sure Jack's mentioned these IMN conferences and you guys have done recaps on them. We would meet at those sorts of conferences and, just got to talking over the years.
So what was the puzzle piece in the company that you filled when you came aboard?
Product knowledge and Rolodex, right? I think with all sales, right? There is an ability to go out and talk to large institutions and going out and saying, hey, look, we have this amazing product. And I had gone out and, after we raised the capital, as Jack was indicating in our prior podcast, you got to go deploy that capital, which is very, very hard, and then operate, which is the hardest of all of it. So I had experience doing that as well and was able to kind of communicate, with all the large owner operators out there and show them that potentially there was another way to do their acquisitions at the time.
So explain the platform,
yeah.
How is it that Entera fills the void? And then my second question I'll come back to.
Yeah, sure. So Entera really is a SaaS and service-based platform, right? So the SaaS-based of an entity is how we can digest large portfolios, understand what those portfolios are going to look like. And we can go out and also on the acquisition side, we can absorb large amounts of data from the MLS and from appended data sources. So you can underwrite properties, decide whether you want to buy that property or if it's in your own portfolio, sell a property using all of those. And then we can go up and either using we have access to our own marketplace, we have access to builders, and connect some of those dots. And then we have a transaction-based team that's geared for high efficiency closings, negotiations and transactions. So it's really able to do the full circle of both acquisitions and dispositions, both on the long-term hold side for groups who large institutions, an enterprise and mid-market groups who want to do that, and then on the fix and flip side, right, encompassing some of the models on an ARV side and saying this is how I want to buy a house and these are the areas I want to be in, and it allows them to be confident in their acquisitions and dispositions.
And even some of the operations as well. You mentioned that we have access to contractors and things like that.
So we partner. Yes. So, not only through our kind of long-standing relationships, but because of the demands that we have in both the acquisitions and dispositions, we have partners that we talk to all day long in both insurance and in construction, and in title, right? And I think that this is kind of one of the coolest areas I've seen in the progression since Jack and I first started back in the day was there were no national providers of anything, right? There was no ability to go out there and say, hey, I want to go buy in Texas, I want to go buy in Florida, and I want to go buy in Charlotte. But I got to find a property manager in all three markets. And then I got to go find a title company, and then I got to go find an insurance. Now you can actually find very high quality, best in class or best in class partners for all of those. And we work with all of those groups. And then at the end, we can help you with the data and reporting, all the analytics you need to do to make sure that you're buying and selling the right homes as well.
So who's a typical client for Entera?
Yeah, so typical clients range from the big three large enterprise groups, all the way down to anybody who's going to be buying or selling more than, 10 to $15 million of real estate a year. And that's who we're really targeting. That's where it makes sense to, I think mitigate from using your brother-in-law as an agent and looking at an Excel spreadsheet to saying, I really want to superpower my operations. And how do I go do that? Well, I have this platform that allows me to go do that. And so I think that that's where it starts to make sense. If you were going to go buy 3 homes next year, I think again, go hire use Zillow, the very, operate, an agent, go out there.
Yeah, local help. I mean, obviously, if you're buying 3, 5, 10 houses, you're probably not, spread across the country, I would think. Right. So you mentioned that you guys operate in 13 markets. Is that still true?
Sorry, no, we're in 33 markets, 19 states. So we've grown over, since that was almost our original footprint. And so and that's all been client driven, right? And which is great, and to see them expand and to see our client footprint expand across the new markets, right? And so it's all the, your typical core markets, Sunshine States, Denver, Phoenix, and then we get into some of the yieldier Midwest markets, which has been phenomenal for us.
Yeah, good, Jack.
So how has the market changed from your perspective since 2018 in terms of particularly amongst like the crowd that you're trying to serve, like, the institutional or the higher volume buyers, both from the, property pricing perspective, financing perspective, like what have been like, what's the wave felt like from your perspective?
That's a great question, right? And I think that, all of those, it's that 3-legged stool that has really kind of ebbed and flowed. One is kind of the service partners becoming more adaptable, right? So whether it's insurance or construction, 2, it's that lending, right? As we've seen and talked about earlier in our prior episode with, the agencies entering and then removing from them space, and large groups being able to finance portfolios in the securitization market, watching them go. And then just, the good old fashioned supply and demand of housing over the last, 8 years has been probably some of the most interesting things we've seen, I think, right? Like where you've seen just supply going down to, MLS listings going down to 400,000, 380,000 nationally, and in one, right, causing just a huge, land grab or a grab for every asset that was out there, and then back to where we are now, inventory levels are settling in around, 800,000 to 1 million on the MLS, right? And starting to see supply gluts in certain markets, and I think that, groups are also becoming smarter, not just institutions, but everybody, whether they're getting their data from us or from whomever, or I think that groups are just becoming smarter the way they operate. They're be able to improve their NOI margins, and because of these service providers becoming smarter. And I think that people are becoming creative, which is always cool to see, right? And how you don't just need to go buy a home, put it in a portfolio and hold on to it, right? I think the groups are trying to do, whether they're successful or not, they're at least trying new things, whether it's shares in homes, whether it's, like with Atticus LeBlanc over at, co-living opportunities, right? I think there's all these unique ways that groups are looking at the space, short-term rentals, right? That's providing everybody an opportunity in the space to do unique things. And so that's kind of how I've seen, right? So it started everybody doing the same thing. Things got better as far as financing and the, service partner things, which allowed groups to do more fun things in the space. Inventory tightened back up. You needed to get creative, and find ways to make it work.
Are you seeing things open back up, given that since inventory is increasing and continuing to increase, has increased and is continuing to?
Yeah, I think that, from our side, right, I think it's still, for every acquisition, we're probably at 1.75 selling homes, so dispositions is still outpacing our acquisitions front. The large institutions have started to come back in. The key component to all of this is understanding and having some in the rate environment, right? And having some stability in that rate market, whether it's at, I look at the 10-year versus you guys on the 5-year, but if we can stay in that 420 to, 4.5 range on the 10-year for the foreseeable future, and groups can understand that, then they can go out and start making acquisitions. Our clientele typically cannot react to volatility, right? I know long-term volatility is fine if you're always going to say, okay, it's always going to be some sort of way, but for the most part, they need stability to go out there and, as we were indicating, having those going to their capital partners and saying, all right, we need to go deploy. And then by the time that's out there, is that opportunity still there? So they need stability on their side, but the acquisitions front is starting to open back up. It's very market specific, right? I think that there are pockets in the world or them, across the United States that are very interesting. And we continue to see Charlotte and Dallas outperform as far as acquisitions front. They're very stable markets, right? Then you have markets like Port Charlotte and Lehigh Acres that, you have 10,000 homes 10,000 homes on the market in each of those alone, whereas you only have 10,000 homes in Charlotte, right? And so if you just look at the populations for those markets, you can start to see some opportunities.
I've heard a lot of speculation from a lot of different people, and I've gotten a lot of different opinions on this idea, but I'm wondering from your perspective, I think your perspective has more credibility than most in terms of the thinking behind, like the feedback from institutional real estate investors as to why they were buying so much in 17, 18, 19, and why that pace has declined. What combination, because we've continued to see, the theory that I heard 10 years ago was that Wall Street's, there was one camp of their bunch of knuckleheads that are going to come up operationally. And
Yes.
another camp that was, no, they understand what the true value of this real estate is, and they're the smart money. And then another was that it's okay. They know that they're not making money on a current basis because the data that they're going to get is going to lead to some other revenue models. And this is like a longer, more evil genius 4D chess play. So I heard that about their behavior 10 years ago. And then when they stopped buying, everyone blamed interest rates, right? That was like the easiest thing to do. But home prices have continued to increase. So hey, where'd the evil genius go, right? Mm-hmm. Just because, they're not buying with as much leverage as your average Main Street investor. So from a deploying, return on equity perspective, had institutions continued to buy in 2022, they would have done well. They would have done just fine. But they stopped. Has it always just been a cost of capital? Hey, I can borrow money cheap enough. Are they purely looking at it on a levered basis and not taking much home price appreciation into consideration? Or is that a market by market idea? You get what I'm driving at.
Yeah, I do. So I think that you were spot on into kind of that 2015-16 group spot with such velocity that they ended up with stockpiles of homes that were sitting vacant, getting just absolutely crushed, and they had to improve their NOIs. They also didn't know how to learn how to operate more efficiently, and they definitely were making some learning experiences, and they would come through there, right? But most recently, I think in 2020 and 21, right, it's easy to say that, the rate increase really brought that upon themselves, and that's why they couldn't buy any more homes. I think the other component to a lot of that is that the entire CRE market was imploding, and what groups, when you have to go say, okay, that, go hit up your average, investment manager and say, hey, I'd like $150 million more to go deploy into single family rentals. Well, in order for them to go do that, they had to go sell assets. And for you to go convince a large institution to go sell a Class A office space in New York at 40 cents on the dollar and take that hit so they can go buy SFR, I think was a very tough argument to make, and still is to this day, right? So I think one component that people were missing was that redeployment of assets and asset allocation to this. So it's easy to, if money was just sort of this thing that you could go grab and, off of a tree, and then yes, I think the tailwinds one always support SFR, right? That there is, there is moderate, home price appreciation. There is moderate rent growth depending on the markets, right? It's a good asset class to own in the long term, right? And those sorts of tailwinds always support it. I think it was just the asset reallocation became very challenging for large institutions to go say, sure, I'll give you that, even though it's small, right? Like, and I think this is always the funny part in our space is, we were talking in our last episode of large numbers. I mean, where, the 300,000 homes that all the large institutions own, right? It's such a small component of it. And we talk about going and raising $150 million, there's large CRE shops that are going to go close on a $150 million deal today, buying one asset. And it's like, oh, I just bought 2,000 industrial square foot portfolio and I spent $1 billion. So I think that it's those sorts of things, but when those markets are falling, they have to go sell that $1 billion portfolio at $600 million, which becomes very challenging. And I think that was one of the biggest.
Yeah, that's an interesting perspective. That's something that I really don't think that I had thought about as much. Like the idea that if you want to pull somebody into the space, that's an effort, and that's a long-term effort. You don't do that with a pitch deck, like a single pitch deck. You do that over a year or two and get them comfortable with the space. But then once they're in, cool, they're interested, but then you're part of their portfolio, and their assets under management are relatively stable. And as a result, if you want, you want to increase your allocation within that portfolio, it's got to come from somewhere else. You got to bring a new player into the market. And it's a tough sell to bring a new player into the market when, when there's not as glaring of an opportunity. That's an interesting perspective. I hadn't really considered that.
Yeah, it is.
And I think that's why build to rent has had some successes over the last, 2 to 3 years or 3 to 5 years, right? Is that it's an asset allocation from multifamily that they're still able to convince groups of. And so that asset allocation is able to go to there.
Yeah, gotcha. What have you seen in terms of like, you've added a lot of markets. Has that been, I was looking at your website and the markets are, cities that everyone's heard of.
Yep.
What has been your perspective there? Like, has there been a shift from home price appreciation into looking for better gross yields, or has that been a demographic play? Like adding Ohio, is that like because we think that climate change is going to be, Ohio's going to be a beneficiary to climate change, or just because you think you can still get a 12 gross yield there?
Yeah, I do think that it's as simplistic as the gross yield play. Right. And how do we balance our portfolio we need some 12 so we can go buy in Dallas. Not that Dallas is a bad market. Dallas, you can get a gross yield of 9.3, right? Or Houston 10, but your net ends up being pretty low due to, some insurance and taxes there. And so I do believe that there is it is just going and buying those markets. And they're also cautious, right? They're not just going to go into a market that has a high yield. They are definitely bringing in the economics factor, right? What's the migration patterns looking like? What are the big employers doing there? I was always wrong, but I always thought that like Orlando and Vegas were going to be death trap markets because they're single employee cities. And and that we even saw it during COVID. I thought Orlando and Vegas were going to be toast, and they performed well still. And so there is enough opportunity in those markets still that I think that, those markets will survive. But I do think that in, the higher yielding markets, they're more cautious, right? And saying, all right, what's our employment looking like here? What is the migration trends there? And something else too, I think that, you are asking about the ebbs and the flows. I think that why people stopped buying, it was we talk about spreadsheet performance versus actual performance. I think that what people were underwriting to became not true. right? And I think they were seeing it a lot on the build to rent side, where they were anticipating 10% rent growth year over year, and all of a sudden that dropped to 1%, and those assets were not performing the way they thought. And so I think that also caused it to pull back, Jack, and why they were not allocating as much capital to it was just the actual performance of their underwritten, that they said, they took some data point that they read, or they looked at some home price appreciation graph and said, and we'll just do this over a CAGR graph over the next 5 years and we'll be awesome. And that was not the truth.
Yeah.
So I keep getting these little trickles of info about markets that are sort of cooling.
Yes.
You mentioned two of them, like Dallas inventory increase year over year is 50%, Orlando's 76%. Is that an opportunity for your guys, or
That's a great question.
Is the bid to ask like just still, doesn't make sense?
That is, and it's really interesting. It's something we're watching very closely. We were in Port Charlotte, right, for example, or Lehigh Acres, or some of these other just incredibly saturated
Jack,
markets.
we tried to do a loan for a guy that was building 10 houses scattered site in Port Charlotte. He did build them. We didn't do the loan, but dying right now. Can't sell.
Yeah.
I mean, cannot get rid of them.
No.
Almost, he was like, it's going to be 375 on the back end. He's at 345, 330, 325, and they're just like, hell with it. We're going to term it out and, maybe hang on to them.
So what's the interesting thing is that the prices have not come down. So if you look at all of this inventory, and this is the really interesting piece to all of those markets right now that we're watching, is that even though inventory is going up, prices have yet to go down in any meaningful fashion.
Absolutely.
Right?
That's the exact data that I have. I mean, if there's any decline, it's negligible at best, but it's really still sort of sideways.
And
Can I offer a theory there?
Yeah.
So I had this conversation with an ex public official in Baltimore, because we were talking about what's going on in Baltimore, like community development perspective. And so here's because there's been a big run up in prices, and a lot of flipping activity and in tougher parts of the city. And that's been great, because a lot more houses have gotten renovated because because folks have been successful and they're setting comps. And then now there's something, comp to kind of like, springboard off of. And my point, and they were like, what, how is this happening? Like, is the, what are the public policies? What has the Department of Housing and Community Development done that was so genius that has resulted in such a significant community redevelopment activity over the course of the past 5 years? And I'm like, no. Like this, you have nothing to do with any of this.
Like literally.
And so I know we bring up this a lot, and I don't want it to sound like we're talking our own book, but it's kind of the thing where like the DSCR product has been really, really impactful to the industry. And so we got into the DSCR product. Not that I'm just like talking that I'm trying to make the DSCR product sound like God's gift to everything real estate investing. But I think that it has really had a significant impact on the calculus for your average real estate investor, because back in 2018, all time before that, if you were a flipper and you went and you flipped a house and you couldn't get it sold, you didn't have a backup plan, or your backup plan was call up your banker and deal with a 4-month refi process. If you had global debt service coverage ratio and all of your shit was tight, then maybe you could get a refi. And as a result, that was a crappy backup plan, like a really not. That was and for a lot of people, it was just not an option. Like they weren't going to get, that wasn't going to happen. They knew they weren't bankable. There's a lot of real estate investors that are not commercial, local bankable, if they had the stomach for the awful, service, level that we get from our local bankers these days. But so there was really no backup plan. So you dropped the price. So when you didn't sell it for $225, you dropped it to $210, and then you dropped it to $190, and then you dropped it to $185, and you let it go. And as a result, the market set a new comp at $185, and everyone else who didn't drop got because all of a sudden there was this comp that you had to talk this appraiser into ignoring. But now you don't get $225, you don't drop it. You just say, fuck it, I'll keep it as a rental. And you refi into a DSCR loan. And if you got a 680 credit score, you put a tenant in there and you refi into a DSCR loan. And that's your backup plan. And you get a liquidity event and you live to see another day. And that never existed before 2020. That was not an option. That was not a thing. And as a result, prices have stayed up because flippers who can't get it sold become landlords now. Like that's all they're doing is they're just becoming landlords at a much higher frequency. So we don't. So in those, like, to your point, like in those potentially declining markets, you don't really know where the number is. And hey, it's not as if there's like some convention where all the real estate investors are getting together and being like, nobody set a lower comp. Like it's not as if this is like a concerted effort. It's just that the economically rational thing to do is to go get a DSCR loan and not set a lower comp. And as long as nobody sets the lower comp, the appraisers keep using the last comp at 225. And no one knows that the real number is 190, but it is, right? So like, I'm nervous about that from our underwriting perspective. Like I think about this a lot because of our RTL underwriting business. I need to know where V actually is. And so this is something that I think about a lot.
Yeah.
But anyway, that's my thesis on like what's really going on there and why we're seeing racks up in like increases in inventory without corresponding declines in clearing prices, because they're not clearing, they're just becoming rentals.
Sean,
they're also more comfortable.
Blow holes through all of that, Sean. Go ahead.
No, I think he's actually probably spot on for a decent percentage of it. I also think let's say that constitutes of 60%, 50%, I don't know. But I think that there is the component too of days on market. People just pull the listing and, they'll just pull the listing. And so it never gets sold or dropped. They just pull that, they'll pull it because they're not forced. There is no economic event right now to force them to move. They would throw it on the market for $220,000. If it's sold at 220, if it's sold at 210, great. They're out of here. They're going to go live their life in Indiana. But there is no reason for them to sell, so they pull it right off the market. And so I think that's one of the more interesting things. So it's that opportunity, it's coming. Right? You can't sustain that, that will not be sustainable to there. Right now, the flip side is that the builders are slowing down too. So I don't know how much those guys crushed Phoenix, Florida with a lot of new build inventory, right? And permits are kind of down on the build to rent side, right? They're starting to slow it down. So I don't know if that new inventory is going to play into effect as much as, the existing inventory.
So then getting back to my question, is there not an opportunity yet in these markets that we've spoken of with just, a pretty substantial increase in inventory? I mean, 50, 75% is not, we're not talking small numbers here. So there's no real opportunity for your clients yet in those markets to go.
So our clients are still focusing on the core, the high performing markets. Charlotte is always an outperforming market for us. Dallas, Houston, Kansas City, Orlando, all of those markets continue to outperform. They're good gross markets. They're easy to operate in. They're limited natural disasters, Houston aside. They're resident friendly. They're also owner operator friendly. So they have that right mix. So I think that those markets our groups are staying, they're staying right in that core. I think that what's also interesting in the last kind of 3 years too, is we've seen institutional buy box switching, right? Meaning that, groups are trying to buy newer assets and, they're staying away from kind of the existing 1950s to, right? And so for various reasons, even though, if you look at a 2005 built home, that home is now 20 years old and it's just as expensive to remodel it now because it's going to need a new HVAC, new plumbing, all of the new kitchen, right? It's got that weird angled design from the mid 2000s that you're going to try and remove. And so I think people are just trying to find their sweet spot of acquisitions, and it's probably not in the these type asset yet, which can provide a huge opportunity for the smaller retail investor.
Absolutely. But to your clients, I would think with the slowdown on the builder side, because they're just seeing less sort of, retail demand, I would think that would be an opportunity then for an institutional, B2R company to go in and just, hey, we're going to buy 50 homes from you in Florida or Orlando, or I'm sorry, Charlotte. Like if you're seeing, because I've been looking at Florida as a place to go live. And we looked in St. Augustine, Sarasota, St. Johns County. Dude, there was no lack of building going on. I mean, hey, we're doing 9,000 houses in this one. You go one development over, we're doing 5,000 houses in this one. And the question is, if they're slowing down because they're seeing less consumer demand, isn't that an opportunity for the bigger guys to like go in and buy up some new assets that they really want?
You would think. And it's starting to happen. Now, this gets into a whole other sensitive subject, but the home builders love their margins,
Oh
right?
yeah.
And you saw, Pulte the other day, they like to hang around that 26 to 27%, margin. And so anything time you start to affect that becomes difficult for them to sell. And so they can hold on to it because home builders, Jack was talking earlier about like IH and their cost of capital. Home builders have the cheapest capital in the world, right? Like
Yeah.
they can raise money from the equity markets. They can get cheap debt because they're all, A-rated companies, and so they can sit on an asset for a while, and so they don't need, now the small regional guy or the small, home builder, he may be forced to sell. And that's where we do see some of our institutional clients picking up. And and that being said, our institutional clients do buy directly from the home builders as well. They have, they've got some tight relationships with, the top 5 home builders out there, but the rest of them, there's opportunities to be picked up.
Hey, I want to make sure, Sean, it's Entera for those. It's Entera. Entera.
Yes.
Entera, and the website is entera.ai.
Correct.
What's the AI about?
The artificial
let's get
intelligence.
into the tech.
Let's get into the tech and the modeling. So there's a couple of different components, and I think this is more of just like how natural language and AI is going to help all of us. But there is opportunities when we're identifying properties for the machine. Let's use the collective machine to become smarter, i.e. when you look at a home and you say, this home is a good home for me, I want to buy it. The machine can start to recognize more of those versus also when you reject. What is the reject reason? I don't like it on this side of the street. I don't like it, with power lines. I don't like this, this, and this. So they can get smarter and smarter. So when acquisition volumes are really picking up, right, that becomes a matter of seconds to underwrite a house versus a matter of 20 minutes, which is very, very crucial when, volumes are going high and you're underwriting and sending out a lot of different offers. That is one of the key components, right, is identifying assets too, is on the dispositions, right, where you're identifying your properties for best use scenarios and not having to go through and underwrite individual properties, but being able to look at a portfolio in a matter of, an hour versus days, right? And so trying to do some of that first glance work. It also works throughout the company and various, closing, I think is going to make huge strides. And, how does that look for documentation? It's very hard, as Jack, I'm sure, is very familiar with. Every state has their own state promulgated form for the housing, for the National Association of Realtors. There's no similar form. So you have to be familiar with all of these forms. And I think that our technology can be valuable there. And that's how we're starting to implement it.
So do your clients have within their login, they set up their buy box, and then is there like a machine learning, an ML that attached to that account? And so based off of like, hey, here's your original buy box and let's feed you stuff. And then based off of how you select, the ML will refine and try to serve you stuff that it thinks you'll like.
Correct. That's it. Right. And so it's geared towards it's tailored towards each environment. It can be tailored towards a strategy as well, not just a client, i.e. I want to identify homes and good school scores, but very refine that in like this zip code that performs this way so it's not just a simple filter, but you're adding layers upon layers and upon layers. And so it all of a sudden looks like something that would take you days now can take you moments.
And you're feeding your clients the MLS available inventory, and then if they've got if they've got an off-market portfolio, you can send that portfolio through also.
Off-market, builders, and we've got relationships with the builders themselves. Yeah, and so all of this digestible, we're source agnostic at the end of the day, right? We can, we'll take leads, we'll digest those, we'll work with the, various groups, and we're coming out to broaden our marketplace, which I think is going to be exciting. And so how can we work with various groups to keep groups from the inventory flowing through? In the investor community, I think is a huge opportunity because that tail investor world is actually so large, right? I mean, if we indicated that institutions only own 3%, there's a huge tail to go out there and try and capture.
So like of the houses that you guys are selling, are they mostly to homeowners or to
Yeah,
other investors?
100% actually. I would say not 100%, but I would say if we did that, I would say our institutions are selling probably 95 to 97% to retail and retail buyers, first time
Wow.
home buyers. So those inventory, again, you can take what you want, but those homes are going back that have been remodeled, that have done to an institutional, spec. Those are coming back into the market as well.
That's interesting. I always thought that like it would, we've crossed the Rubicon in, institutional buying of SFR. And I always had this theory that like these houses will never hit the market again. They'll just like, be traded amongst the institutions.
So I think what's happened too is as groups have become sophisticated over the last, call it 3 to 5 years, it's really taken on a more of an asset management approach that you see very similar to your stock portfolio, right? Where you are now trimming, if you call up your stockbroker and whomever, go to your Robinhood account, right? It's not just suggesting you sell the total dogs, but it's also suggesting, hey, look, you've held Apple for 3 years, it's up 9,000%, making it up. Probably time to take a little bit of the chips off the table and go reinvest in something else. And that's exactly what's playing out with our groups as well. It's all right, let's go sell. And I think that theme will be, they'll look to sell 2% of their portfolio for the foreseeable future. Right. And, and that takes some effort too, right? They've had to learn and we're helping them learn on how to, get smarter on the disposition side, also working with the lenders, right? And, trying to get early release penalties removed and out of the securitizations, right? And what are the tax implications for the REITs? So there has been some of the learning, there's been a pretty good learning curve on the disposition side as well that we're starting to see. But yeah, I think that those homes will, and where prices are right now, right? Like there is a dislocation from where, if investor A wants to go sell it, investor B will buy it down here, but retail is still going to pay up here for it. So it's not that it's just going to be not horse traded. It's just that the retail pricing, that national average of home prices keeps going up. They continue to pay for it.
So
You mentioned,
go ahead, Jack.
you mentioned a little bit, just to dig into about the methodology behind the dispositions. You mentioned that it's not just the dogs, it's also the, sometimes, hey, this has been an area of rapid home price appreciation. And so your opportunity cost of the capital that you could unlock there could be better spent. Like sell that and go buy 2 more, you'll get twice as much.
You got it.
I'm curious to dig in a little bit more to the mentality around the culling of the portfolio.
Mm-hmm.
It's something that we do, but like my initial, the initial temptation is like, all right, pull out all the performance and like rank them best to worst, worst to best, and like show me all the dogs at the top. And wherever I wherever I had minus $8,000 of cash flow, get rid of it. Then when I would dig into those situations, it would be like, yeah, but like those are all stories, right? Like I'd be like, hey, I want to sell these 12 houses. Everyone cool? And then I'd get 12 stories where it was like, well, that was really, we found the sewer line was an old terracotta pipe and we cracked it and we just spent the $9,000 digging up the backyard and now it's got a brand new pipe. So that shouldn't happen again. Or the HVAC went out, or that was just a really bad tenant because, remember like 3 years ago, we were stressed about our vacancy rate. And so we like started flexing on the tenant screening criteria. Yep. And like they were all they were either stories or self-inflicted wounds, but I shouldn't. And as a result, I shouldn't hold it against the house.
Correct.
Like, are they selling any dogs or is it all just the opportunity cost of capital idea?
No. It's a combination of both, right? And so you're trying to get rid of both, the barbell of your portfolio. And so they're definitely selling some of the underperforming assets, whether that's underperforming because of
it's on a double yellow line.
Yes, exactly. I was just going to say property, right? They can't, it's not in the school score, it's not in the school they thought. It's, it's got challenges regarding this, that, or the other. Or they're selling them because, they did take, 10% HPA over the last 2 years and that may not continue. So let's go take that off the plate and go buy 2 more homes. And so I think that that's exactly it.
Interesting.
And that's going to continue. Just like everything, right? You've seen it in the multifamily, you've seen it in, you see it in your own stock portfolios, right? It's just understanding both the, the goods and the bads, and having the conviction to actually sell, right? Like as you were indicating, you rank those high to low, and you're going to only sell the ones in the red, right? But it's actually having the mentality and understanding that you do need to sell some of the ones in the green too.
That was
to
always the
maintain it.
story around like, hey, why, in the 12 years ago debate about is SFR an asset class or a trade, this was always part of that narrative, right? Where hey, and here's the upside. It's even better than multifamily because you've got the optionality to, on the turnover, renovate it and sell it to homeowners. So you can call the dogs and where you've fortunately had some home price appreciation that you didn't even know was going to happen, but all of a sudden this neighborhood is gentrified. You'll be able to sell those and harvest those gains on a more granular basis than multifamily, where you can't make a decision to sell unit 3F or unit 1C. Like it's sell the whole asset, or sell the 100 units or don't sell the 100 units. It's a binary decision. Have you guys, so you're seeing that, right? Like you're actually executing on that optionality, which was part of the pitch 12 years ago. This is a total, you could be like, no, we haven't done this yet, but have you been able to quantify the impact on returns that optionality has provided on relative
all the time, because we're not provided with the cost basis all the time, right? And so, or the performance of each and every asset, right? So we can say, hey, look, we believe, we have some cost basis information, right? But we do say, all right, versus this, we do think that you're up here. There's some component. We also don't have all the financing that plays into it, right? And so, but we do make some, what we can do is we take a lot of the, the market demographics and say, is this improving? Is this not improving? What's the HPA? We can look at it that way. We also can go into these houses and say, hey, look, if you were to sell these 5 houses, what's your repair schedule going to look like? Do you want to go into this house and put in $12,000 to get in 100, to 20,000, or should you not even, you could sell these 3 houses right now as is, maybe give a seller credit of $1,000 and move on, and you'll actually take some profit. And so that's where we're getting smarter as well with some of these groups and helping them not only what assets to sell, how to sell them,
right?
From an asset management point of view, which has been very interesting and fun to watch over the, because I will say the dispositions is a lot of art and science too. It's not only.
I started doing this like 2 years ago. Because I was getting out of touch with what was going on in the field. Like we'd have properties that would turn over, and then they'd do the turnover, and I'd be like, it was a $27,000 turnover. Like, what the hell was that? Like, dude, we're murdering ourselves from a cash flow perspective. And I was like, if we were going to spend 27,000, we should have spent 38,000 and sold it to a homeowner. Like, why'd we spend 27,000 to end up with a rental? Like, exactly what you're saying, right? Like I was being kind of lazy about asset management. And
and I think it was, it's an evolution of this industry, right? Where we are not used to, we were so focused for 10 years on just buy a house, perform, and then if it doesn't perform, if it burns down, get rid of it, right? And so the actual asset management, I think, is an evolution of it.
And the same considerations you're talking about, like, hey, this, what is retail now? Oh, wow, this neighborhood's way up. But you know what? I do have, 30-year debt on it at 4%. So you know what? I'd have to give up that. And that's an asset. Right. And so, I'm doing all those, taking all those things into consideration. So I started just like literally going to, so every 2 weeks I hop in the car on Saturday and I just drive, the 6 turnovers that have happened in the past 2 weeks. Send a little message to my team being like, we're keeping this one as a rental, or we're going to like add central air to this one, or like just paint it and put it on the market.
Yep.
And, making a case by case, decision on every turnover, because it's an opportunity to do exactly what you're talking about. Be smarter about asset management.
It is, which is cool.
So getting back to the tech, Jack has talked at length about how Dominion Financial is an early adopter of AI. We've spent a considerable amount of money on building it out. But I still believe that like, it's just so, you can do a lot with it these days, a lot. But it's not quite at a place where it's making decisions and sort of like really helping your business yet. How is it? So what type of lift was it for you guys to implement AI? Did you bring people in-house for it? And then how do you really see that changing the business in like 6 months, 12 months?
So we have half of our company is based in technology and data science, on that side, and development. So we are very tech heavy on our employment, which provides us the opportunity to come up with some really creative solutions, and driven by product, right? And so how does that fulfill the customer, right? And go, what can we implement from that stage? The AI component of it was obviously a big push for us, and it really does allow the underwriting to become more efficient and faster for our clients. And that's really where that comes. I don't think we'll ever become 100% automated, to your point, right? Like, I think that there always will need to be some sort of human overlay.
Yeah.
And I think that that's our goal, right? Is to say, okay, if there is, what do we say, 875,000 homes on the MLS out there today, and I want to go underwrite them, how do I do that in an efficient manner? And that's what the question we really started to solve, right? And say, okay, you have 875,000 homes. These are the characteristics from both a physical and from a financial characteristics, right? And the machine can digest there and produce 12 homes that you can go actually say and do confirmation analysis and go boom, 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 right?
That's
and
crazy.
then go focus on your day of asset management or coming up with other things, and identifying other markets that you want to be in, looking at other strategies, right? So the actual acquisition part becomes almost seamless, but I would never want to see it become fully automated. I think that you can look at, there's still really good bond traders and stock traders out there who are sitting at their desks every day, crypto traders, whatever asset you want to trade. You're never just putting on a machine and letting it go and having full success. You may have some algorithms that are saying, hey, these are your buy signals and these are your sell signals. So those are what we're helping identify through the.
Anything to add there, Jack?
No, I was just curious, like when I've done that on a very, not nowhere close, but just like, set up when I've set up a buy box and like had, set up a fancy buy box, right? Like spent a whole bunch of hours trying to set up this buy box and get me, all the stuff that I want. One of the things that I found is that it would start over-representing certain locations that were like, just because it happened to fit the buy box, it was feeding me everything in this particular townhome community. And it turns out that, like, I don't know, there's something wrong with that community, or some that the gang has taken over that community, and as a result, like, everyone's a seller there, and it keeps popping up on my buy box because it fits my buy box, but I don't realize that the boys are there slinging, and as a result, if I bought everything in there, I would all of a sudden own 20% of this, like, not great spot. So like that human overlay
In there.
still like matters, right? You still got to put the boots on the ground to, like,
You got it.
make sure that you're not, some reason the algorithm hasn't just like invested you into a bad situation, because it'll do it, right? Like, otherwise it'll do it.
Right. Until you click on that first reject. Why don't you want this area? Why not? Well, because there is,
your feedback. You get a feedback loop. I don't have a feedback loop. Yeah.
And that's what the vital part of that is, right? Is having that feedback loop into the machine, so it then learns, right, and doesn't over allocate you. You can even program it to say, I do not want an allocation of more than, X% into this zip code, right? And so it's only going to feed you the 20 best opportunities in that zip code or something along those lines, right?
Were you guys in Entera.ai back in 2017, or when did the AI
18. Yeah, I think that since its inception, it's been Entera.ai.
So that was like, in 2018, because everyone like wraps these things together, right? Like that was probably machine learning in 2018. It wasn't LLM, because LLM was like a 2022 thing, but everyone now associates AI with LLM because of ChatGPT and all that.
Correct.
But before LLM, AI was the latest and greatest in AI was ML.
And it was the modeling, and it was also like the natural language processing, right? Taking what a real estate agent has said in their cute cottage needs improvement. What is that? Yes. what does that equate to, right? Like,
That's
what
awesome.
is it, can we assume in a construction budget from that natural language processing? What can you assume?
Make it your
And
own.
one of the hard ones too that I still think there's an awesome opportunity for is picture identification.
Oh,
We
that's
do
going
a
to be key.
we do
Awesome.
a very good job of getting you there from what the current state is in a photo, what the what the existing state of the higher quality comps are to give you a construction budget. And that's another area where we get our modeling is very strong. What it doesn't, and I'll use Florida as somebody once gave me a great example that the difference between a deep dock and a shallow dock is about $100,000,
Oh
right?
yeah.
And that is not a picture. There is no machine. What you would have to do is take in some title data and some other third-party sources. But for the most part, a machine just can't look at a picture and say, yes, it has a dock. Well, is it a deep water dock or is it a shallow trolling dock for my fishing boat? Because that is a huge difference on there. You're also at the agent taking the photo, right, is not always going to accurately take the crack of the foundation. It's not always going to take the picture of the black mold in the corner. And so the machine is only as good as those. It's very similar to the data, right? We're all struggling on, using assessor data, but it's only good as that data going in. And so, Adam and all of these guys, Core, all of them use the same kind of similar data set, but we can only clean it and scrub it so much. You're still relying on a $25,000 to $40,000 a year government employee implementing,
At the clerk's office. Yeah.
yep, and implementing that information correctly. And so, and also historically, right? Like, what kind of a home is this? Well, it's a 3-1. Well, that was when it was bought in 1942. Is it, was it a 3-1? Is it not a 3-1? So,
So just a couple minutes left here. And again, appreciate your time. Very generous with it. We talked briefly about sort of the regulatory environment. You mentioned that you attended David Howard's, who we had on the podcast, the National Rental Home Council convention or meeting. One of the things that Jack and I have talked about a few times on the podcast that I continue to keep an eye on is sort of like these local city and state, municipalities that are putting in like some kind of draconian, proposals that could become law. Most of them have not, but in certain states around the country, LLCs can only own 1,000 houses. Some of them say 10 houses. Some of them say 50. And so my theory of the case there is that in a lot of these places, the local legislators, politicians, they'll shoot for the moon, but then they'll just keep taking a bite at the apple until they figure out where what they can get across the finish line. And I don't think regulations like this that are limiting the amount of houses that a particular entity can own, I don't feel like it's going away. I don't, there's a lot of money, I'm sure, being lobbied against it. However, I just don't see it going away. What's your take on it?
Yeah, I think it's a really important subject, right?
And Frank, and by the way, Sean, we're not just talking about your clients that like these large. We're talking about like mom and pop guys that own
Correct.
like 50 houses, like companies and companies like Dominion Properties that owns 800. Like it affects. I think it has the potential to affect every investor at every level.
It does, and it stems from a misinformation campaign, right? What's the easy, who's the big bad wolf?
Right. It's always easy to put a target on the back of guys like Jack, right?
And it's easy to do after the collective Wall Street.
No,
right?
no. What? But hold on, Jack grimaces. If you're not watching, my point is it's always easy to point the finger at the guy who owns the property because he's the rich guy, right?
Correct.
Not the tenant. And the fact of the matter is that I've walked through many of Dominion's houses. They're beautiful. The average tenancy is 7 to 8 years. So obviously, they're doing well by the customer. And I'll back to you on that.
Yeah, no, I think that's 100% right. And it's an education thing, Craig. It's talking to local leaders, it's talking to local legislators and showing them the asset quality. Hey, calling them up and saying, hey, come take a look at my 3 houses that I own. And, why am I being targeted as an owner? I think that, that becomes such a powerful thing and, where you're actually humanizing it. And I think Dave, I'm probably stealing his words, but humanizing both the resident and the owner. and saying, look, I own 3 houses. This is my livelihood. I don't have millions of dollars to go spend. But look, I am providing an affordable solution to somebody who wants to be in a good school district, who wants to be, have a better quality, who can't, the challenge is how do you solve an affordability crisis? And I am not qualified to solve that one, nor do I think we have enough time. But I think that if you can get to the local legislatures, start speaking with them, educate them, and it becomes a very real discussion, they'll remove some of that stereotyping of rentals and owner and property owners. And all of a sudden they start to realize, oh, the groups that we're trying to set this legislature up to go affect the enterprise or the large scale groups, but who it's actually going to affect is, Bob and Sally Ann, who own 12 homes, who are a dentist, who have created, instead of investing in a 401k,
Right.
$1 million or whatever, it bought 10 houses. And now you're, punishing them for something that they shouldn't be punished. Now, you have to find a balance, right? I think that having, squatters, new squatter legislation was so valuable, right? I mean, some of the insane cases that you would read about in California or Atlanta or wherever, but there are, you do need to have resident protections as well, right? Just knowing that some of the demographics that are being in residence, they need some, some protections as well, so they're not being victimized. But I also think that the institutions have spent a lot of time trying to give the best resident experience, and you're seeing it. Jack, you mentioned, the average tenure of some of these groups is now 5 to 7 years. So they're providing a very good solution and saying, hey, look, people actually want to stay in our homes, and they're starting. Go look at our street. You can pick out, it used to always be, oh, we can pick out the institutional owner because the long grass or whatever. That's not the case, right? Like now you go look and it is, oh, that house has, 2 nice cars that are actually gone during the day because, their average income is $120,000. So they're working, so I think that removing that stereotype is a long battle, and it just starts with education from the locals.
Do you think it's an issue that's here to stay? This constant picking at the apple, as I call it.
Yeah, and it is until we can reduce the affordability issue, right? Until everybody can find a place to live. I think that whether it's rent or own, it's just going to be something that's an easy issue to kind of target.
Mm-hmm.
So.
No, I get frustrated with I'll speak to my personal experience in Baltimore. So, there's certainly like a tension with public officials, between the landlord and tenant community. A couple years ago, it was about rent court. Concerns about rent. There were just so many people in rent court that it was being used as a kind of a collections tool,
mm-hmm.
which was true. But because the contract was to pay the rent, because we have to pay the mortgage and provide the service and provide the asset at a high quality, right? So it requires money to do that. So I'm a little unapologetic about that one. But at the same time, as a result, they instituted rental licensing, which they hadn't done before. And I think, and we actually supported the legislation because it seemed like a good idea. Like you need to, in Maryland, we have lead certificates because lead paint is still a concern. Mm-hmm. So you have to have a lead certificate, and the city, in its infinite wisdom, many years ago said that it wanted a rental registration. So you had to register as a landlord and pay $30 a year for what I'm not sure what that has provided, just that they know that we exist. And then they added an inspection of the house requirement. And you could use if you were working with the Housing Choice Voucher Program, you could use the inspection pass as that, or you could go get a home inspector and do kind of a health and safety inspection to make sure that it wasn't a slummy house, that that there was GFCIs and there wasn't water in the basement. Just normal health and safety, reasonable, good level of reasonableness. And they put that in place. So the rental licensing in Baltimore got put in place 6 years ago. What they've never done? Cross-referenced the list of rental and so all the landlords had to go scramble and get their rental licenses for fear of this fine that accrued on a daily basis. So all the good landlords went and did that, right? You know what the slumlords did? Nothing, right? They did nothing. And you know what happened?
Nothing
happened. Code enforcement never showed up. because they haven't even cross-referenced the list of non-owner occupied houses with the list of rental properties, with licensed rental properties, to identify in 15 minutes, something your data scientists could do in 15 minutes, identify the list of all the illegal rentals in the city. Now, of course, there's a house on that list where the owner is letting his sister stay, and it's non-owner occupied. He's still paying the property tax bill, but it's his sister, so he doesn't need a rental license because there's no lease in place. Yeah, that's true. Knock on the damn door and be like, no, and then have the tenant be like, have the occupant tell you that they're the owner's sister. But you will, in one fell swoop, identify every illegally rented property in the city. And my strong suspicion, though I don't have any empirical evidence to support this, my super strong suspicion is that you will find 80%, 90% of the negative housing outcomes and get in front of the lead paint lawsuits, and you'll find other crimes happening there at the same time. Those are the houses where that shit happens, right? Mm-hmm. And we can't enforce the laws that we have on the books already. And yet the politicians want to put new laws in place to further restrict everything. And I'm like, why don't you start with just enforcing the stuff that's already on the books? And then we'll see where we land. And then we'll decide, is it really the institutional or the larger professional landlord that's the problem here? Like, I'm like super anti-slumlord because I hate being painted with that brush, because that brush swipes across my arm from time to time because I happen to be in the same business. But municipalities won't go after the slumlords in their jurisdiction. It's a total cop-out to me to like blame the institutional landlords and pretend that they're worse off than the folks that won't fix the toilet, the clogged up toilet, or like has water in the basement. So anyway, sorry, I get all riled up because
it's rightfully put, right? Like that is the issue we're all facing. And I think that all, professional owner operators of single family rentals would fall in that same camp of like, hey, go ahead and, if you want to put us in a rental licensing program, fine, we're happy to. Let's remove, the bad apples that are continuously giving us the stigma, because those are, it's tough. Property management is a tough business, and, but they are trying to provide a valuable service. And these institutional, professional, mom and pop owner operators are also trying to provide a livelihood for themselves.
Yeah, one of the things I have a hard time with the theory that charging a premium price for a premium product is evil. Charging a price for a product, for a service that you don't provide, that's fucking evil. Like let's get rid of all of them, and then we can argue as to whether like invitation
a rental cap is
too quickly. Like it just seems like a cop.
I'll just plug what David Howard is doing at NRHC.
Always.
I think that just this brief discussion highlights the fact that like investors at every level, I think there's always been a stigma against landlords in most major cities in America, frankly, in all of them. But what he's doing is not just like, hey, we're just sitting in an office in DC, trying to figure it all out. Like he's got local chapters being set up in towns across America where, everyone from every level of ownership can participate in. And if you're not doing that as a landlord at this stage of the game, I think you're really missing out. It's, I think we talk to investors every day that wear a lot of hats, Sean, and they're, they're not just like, they're doing a lot. They're busy people. But to take 1 hour a month or something like just to get involved and be a voice at the local level, I think it's imperative right now.
And I also think to that point, right, I would struggle to find a government out there where you can't find somebody in that government that actually is an owner operator themselves, right? They, go to your local government, and I bet you somebody in there owns a rental house.
Hey, even Letitia James owns rentals, there you go. Like, so
everybody.
Yeah. So, well, man, we've covered so much. I hope the listeners got a lot out of it, as I'm sure they did. Can't thank you enough for your time.
No, it's been great.
If folks wanted to find Entera or you, or, tell them where they can find you.
Sure. Entera.ai, Entera.ai. My name's Sean Tierney. I'm on LinkedIn. Always feel free. I love talking about this space, as Jack knows. So always please reach out. All operators, fix and flip, or, anybody who wants to be in this space, happy to talk to them. And so I'd encourage them to reach out. And reach out to you guys as well, because you guys are very knowledgeable in this space. And so I
Mr.
appreciate
Bavier,
that.
any final words?
No, I just really appreciate it. I've known Sean for a long time. I knew we were going to enjoy the conversation and did not disappoint. So thanks for your time, man. Really appreciate it.
Thanks, guys.
We'll both see you at a wedding later this summer. All right, man. Well, thank you so much. That's Real Investor Radio. I can't thank you enough for listening. Please leave us your comments. Love to hear them. And we'll see you on the next one.